The Trade Desk ticker symbol TTD just reported earnings and it was up 11% in the after hours after rallying 6% in regular trading hours. An absolutely bullish move, up 17% on the day. And we're going to talk about why and discuss everything about the Trade Desk, their earnings, and we're going to ask, is it a buy right now? But before we dive in, guys, could you please go ahead, like and subscribe? That would really help me out. Now, you can obviously see why the stock was up 10% in the after hours, 17% today, because we're looking at 25% in revenue growth, 66% in earnings growth. This beat the analyst expectations on both the top line and the bottom line. And then the management team actually went ahead and raised guidance for the second quarter, ever so slight. But in this environment, a guidance raise on both revenue and EBITDA is an absolute win. And that is why the stock was up. Now, the only thing I could fault from this earnings call was the gross margins. It did decrease, but the company is sacrificing margin for a little bit of growth. That being said, the EBITDA margin increased from 10.2 to 12.7%. Free cash flow margin increased to 36.7%. And the net dollar values also increased. Free cash flow went from 178 million to 232 million, and EBITDA went from 50.4 million to 78.4 million. Very solid results out of the Trade Desk right here. And their balance sheet continues to remain very strong, having nearly $2 billion in cash and only $312 million in debt. And probably the most interesting thing about this earnings presentation was they showed this chart right here. Gross advertising spend on their platform and revenue, right? And what's very interesting is in the last year, full year 2024, gross spend increased 25%. Revenue actually increased 26%. This was the same in 2023 when revenue increased 23% and gross spend increased 24%. So this just shows that the Trade Desk, even in 2024 and right now, they are actually takers of price. They have immense pricing power. And even though advertisers are spending more, their take rate actually increases every single year. That is a very solid business. And that is the type of stuff you actually want to see. Now, what the Trade Desk actually does is they're a technology company that provides a platform for advertisers to buy and manage digital advertising campaigns. It helps brands and agencies purchase ad space across websites, apps, streaming services, and other digital channels in real time, using data to target specific audiences effectively. Think of it as a tool that streamlines and optimizes how ads are placed online. And this is just an incredible business. Guys, this was the 11th consecutive quarter of 25% trailing 12-month growth in revenue, right? At the same time, they manage their expenses, only seeing expenses increase 21%. And this is exactly what you want to see in a company that's growing. So there's a lot of operating leverage and unit economics being built into the business. And that is why income from operations was up 90%. However, due to a 1% share dilution on a year-over-year basis, diluted earnings per share actually only increased 66%. And you can see right here, stock-based compensation was $128 million for the quarter. Now, they did repurchase $386 million worth of stock. So yes, while shares did increase this quarter, it did increase on a year-over-year basis. And they only authorized $1 billion worth of share repurchases, meaning they have $631 million available to repurchase for the next year. So they did spend a sizable amount on repurchases in the last quarter. That being said, a very profitable company, but a lot of stock-based compensation, if you ask me. You know, if you're spending 40% of your authorization to still see dilution in the share count, that really goes to show you're paying out a lot of money in stock-based compensation. Now, looking at some Q1 highlights, this is an amazing business, guys. Customer retention remained over 95% in the first quarter, and it has for the past 11 years. So once people are on the platform, it's very sticky, and customers almost never leave. Only 5% do. They saw continued collaboration and support for Unified ID 2.0. That's sort of just to enhance privacy on their platform. The total advertising TAM is headed towards $1 trillion. So they They are seeing growth in the TAM and growth in the company as a whole. The company used $386 million for share repurchases. They believe they are still early in tapping into the large shopper marketing opportunity, and there is significant opportunity for international growth, which only represents about 12% of the total growth. They think that can represent up to 66% because 66% of advertising dollars are actually outside of the US. And CTV is their largest and fastest growing channel, and it will be for the foreseeable future. Now, CTV is the commercial TV space, stuff like Netflix, right? They say they have access to 90 million plus households in the US and 120 million CTV devices. Now, along with CTV and stuff like Netflix, they serve all of these customers across the board from Spotify, Walmart, ABC. You can have your ads placed on all of these platforms. And that is essentially what the Trade Desk do. They can connect you to the whole internet to promote your brand. If you are an investor in the Trade Desk, I think the thing you want to watch is the consumer, right? That's the number one thing I think you really want to watch because if consumer spending slows, advertising dollars are going to slow, especially in a recession, and that is going to impact customer retention as well as growth. So ultimately, the consumer is what you want to watch. And then I also think you want to be aware of AI. I think we are seeing a massive change in how ads are being placed on media. Things are definitely changing with AI. I mean, you need to be aware as to how the Trade Desk adapts. That being said, I still think the Trade Desk's moat is unchanged. I think it's wide, but I think their thesis is still intact and they should grow faster than the overall advertising market, taking market share where they can, especially from the big players. Looking at the valuation of the stock, it's not necessarily cheap. A shareholder yield of less than 1%, a lot left to be desired there. Price to earnings ratio of 34, and this is a forward multiple, and an EV to EBITDA of 25 times. So the stock is actually really pricey, but what does that mean for value looking 5 years out? Now, looking at our valuation framework, so essentially what we do is determine growth in revenue for 2029, apply a margin, and then get our projected return. So for the Trade Desk here, we're looking at $2.5 billion in trailing 12-month revenue, growing to just under $6 billion by 2029. With a 28% free cash flow margin, we can predict free cash flows of $1.6 billion. We're going to apply a 25 times EV to free cash flow multiple, which is frothy. The S&P 500 trades at about 16, so this is a hefty premium. They currently trade at a 43 times multiple, so the stock is not cheap. Then we get the enterprise value, subtract the net debt, get the equity value, divide by shares outstanding, and we're looking at increasing shares outstanding by 1% sequentially. You get a 5-year projected return of about 9%. So despite the stock looking very expensive, right, you can still see here that with the current growth rates of 18.3% and margin expansion, you can eke out about the average return in the S&P 500 over 10 years. Now, if there is upside to these numbers, there's obviously upside to this right here. If they do introduce a dividend, there is upside to that. And if they do buy back and decrease shares outstanding, there is upside to that as well. That being said, the stock isn't quite attractive just yet. And I would say that a more attractive price is probably for the stock if you were to buy it here at the 46 mark. Now, when we had the massive Liberation Day sell-off, the stock did trade right there. It currently trades at about 64 right now after the massive move on its earnings. That being said, if we do get to this 46 mark, that is a great candidate because right here, we're looking at about 13 compounded. You're looking at about 13% in compounded annual returns. And for such a high quality company that's increasing margins and growing like a weed, the Trade Desk is great value here. And you also had plenty of support in 2022 at these levels here at the 46 mark. And again, most recently. So if we do get to this 46 level, 45, mid 40s, this is where I would actually start. I would probably go ahead and buy the Trade Desk. Yes, the stock is expensive, but at the right price, anything is worth the buy. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, leave a comment for the algorithm. Cheers.